Before we move on and look at corporate governance in different parts of the world and in different types, let's just take a little bit of a review of what we've seen in corporate governance and just ask a couple of questions to help understand the knowledge we've picked up so far. One aspect of corporate governance we've looked at is the growing importance of the non-executive director. If you were to go back and look at boards of directors 15, 20, 25 years ago, you're likely to find that the composition of the board was much more angled towards executive directors, with maybe only one or two non-executives giving advice on strategy, sort of acting as consultants, but not really doing much else. Now, of course, boards are expected to have at least half their membership as not only non-executives, but independent non-executives, as close to true outsiders monitoring what the board is doing. Now, we've already seen that there are some fairly clear advantages of doing this for corporate governance, but let's consider both the pros and the cons of having non-executives on the board. Firstly, the advantages. Bear in mind that the average non-executive director is not just sitting on your board as a non-executive. The chances are they're also the non-executive at one or two other companies. They are probably older than the average board member. And also there's a fairly good chance they're also in an executive position at another company. So many non-executives are simply an executive from company A who also spends a little time at several other companies as well. And we need to consider how many other companies you could be a non-executive of at the same time and still be able to add value. That's coming up shortly. But that experience from other companies and that experience from the fact that the non-executive is probably older and has seen more of business life than the other directors, and bringing that outside view should be of real benefit to the company. Of course, another key benefit of having non-executives on the board is their independence. The fact that they should challenge what the directors, the executive directors, are planning to do. There's always a danger that because the executives work together day by day, they sort of form a bit of a club and all agree on the same thing. So to have someone from outside challenging that is clearly a good thing. So by having non-executives in place, shareholders and maybe other stakeholders as well should gain more assurance that the company is being properly managed. Well, we probably knew all that already, didn't we? We've been arguing why we need non-executives, so we've sort of focused on the positives already. What about the negatives? Companies need to have quite a few non-executives on the board Firstly, to make sure that that 50% rule is satisfied, that at least half of the board are independent non-executives. And don't forget, with 3 committees to staff, primarily with non-executives, you're going to need quite a few to make sure those committees have enough people on them. Non-executive directors are not going to be cheap. They are experienced people, and whilst they're not going to be spending a huge amount of time at the company, they need to spend enough time to know what's going on, and they're not going to be cheap on terms of a daily rate. Also, the fact that you've got non-executives in the room challenging strategy, whilst often is going to be a good thing, may slow things down, as they may feel the need to challenge everything just to make sure it's been properly thought through. And one would hope that a lot of things have already been properly thought through. Another potential downside is the fact that if non-executives are not spending that much time at the company and are also working at other companies at the same time, just how much value can they actually add? Is the time commitment and the fact that they are potentially spreading themselves too thinly going to reduce their effectiveness? In fact, there have already been cases where there were non-executives on the board, but they didn't seem to have a full understanding of what was going on, Enron being the perfect example. Because the non-executives are only at the company for a fairly small amount of time each month, primarily to attend board meetings and committee meetings, there is a danger that their lack of inside knowledge of what's happening at the company means that they are too willing and ready to accept what the executives tell them. Bear in mind the executives are in full control of the company on a day-by-day basis, and as such they know the truth. There have been several reports that your average non-executive doesn't really completely trust the information being given by the executives. This might suggest that if non-executives are really going to have a useful monitoring role, they should probably spend more time at the company. The problem, of course, being that the more time they spend there, the more danger there is that they become too close to the executives and lose that independent nature. So there we go, a few small thoughts about non-executives. Clearly there are benefits, but potentially there could be problems as well. Bear in mind that although the directors all sit on a single board, although that is also something we'll need to look at, as in some countries they don't sit on a single board, but if all the directors sit on a single board, there is a danger that groups start forming, with the executives turning up to board meetings expecting a fight with the non-executives, and that can, of course, reduce the effectiveness of the board in running the company as a whole. Let's move on now to a second consideration based on information and detail that we've seen so far on the course by looking at board committees. As we know, companies are expected to have, at a minimum, 3 committees of independent non-executives: the Remuneration Committee, the Nomination Committee, and the Audit Committee. Let's remind ourselves of the benefits of having committees and then take a look at maybe the downsides that could arise as well. Firstly, the positives. Having a separate committee makes it clear that you're taking the importance of particular areas to heart. So it helps to highlight the importance of the nomination of new directors, directors' pay, and the role of audit. On top of that, there are certain members of the board we don't really want around when certain decisions are being taken. So using separate committees helps to ensure that those people aren't in the room. And thirdly, having an entire board of directors involved in every single decision is potentially quite a slow process. Even if the board of directors only has 7 or 8 people on it, getting 7 or 8 people to agree on things can take a bit of time. So maybe it's a good idea to get 3 specialists, put them in a room together, and let them advise the main board on what a good decision might be. So some fairly clear benefits of having board committees. What about the downside? Well, the main downside is that whenever you introduce a new committee, it's another stage of the decision-making process. Bear in mind that the committees will go back to the boards with recommendations, but the boards still need to agree to them. If the board wish to further debate what the committee have suggested, it may actually slow the process down. On top of that, of course, by having the committees, you introduce the need for more and more non-executives, and that costs money. It also costs the time of going and finding these non-executives. Of course, they need to be independent, so simply finding your friends to sit on these committees is not going to work. It's important for the exam that you are willing to consider that the things that corporate governance recommends are not perfect solutions. The advantages of most of them are fairly clear because corporate governance is seeming to be improved, and as a result, it's fairly easy for us to see why these things are there. But just be willing to take a step back and look at the downsides as well. It's not always a one-way street. So far, in looking at corporate governance, we've been focusing on the corporate governance guidance found in the UK's Combined Code. What we need to do now is just consider how corporate governance differs around the world. Firstly, by comparing the UK's Combined Code with Sarbanes-Oxley, the American corporate governance law. We need to consider the differences between a code-based system of guidance, as in the UK, and a legally backed system, as with Sarbanes-Oxley. And then we'll also consider how corporate governance varies in different types of culture. Once we've looked at corporate governance in different parts of the world and how things vary, we'll then ask the question, should we be calling this corporate governance or just governance, organisational governance? Are there things that non-corporates can learn from corporate governance? And what about smaller companies rather than listed companies? Can they learn something too? So we'll look at governance in different types of organisation just to get a feel for how appropriate it is and how far such organisations have taken things. But firstly, let's look at the UK's Combined Code. We'll take a brief look at the history to see how it's built up into what we have today, because that will help us to understand how the code is put together. So, let's go back to the early 1990s and the starting point for the UK's Combined Code of Corporate Governance. As you'll remember from an earlier video, there were a number of corporate failures in the late 1980s and early 1990s, and some of them were very high profile in the UK. As a result, in the late 80s and early 90s, government and also the stock exchange were keen to try to investigate what was going wrong and to try to help companies, and in some cases push companies, towards better governance. Adrian Cadbury was put in charge of a committee to try to find out what was the best way of running big listed companies. And in 1992, after surveying the thoughts of most of the big companies in the UK on the stock exchange, the Cadbury Code of Best Practice was brought out. As a code of best practice, the recommendation was that everyone should follow it. But equally, there was an acceptance that certain aspects of it might not always be the best solution for every company. As a result, the stock exchange adopted the Cadbury Code in its listing rules, and the rule was that all companies either had to follow the code and issue a statement that they had complied with it, or explain any deviations they had taken. So that was 1992 and the Cadbury Code. And to a great extent, most of what the Cadbury Code said in 1992 is still sitting in corporate governance. So you'd recognise most of the content. After the Cadbury Code in 1992, we waited until 1995 for the next major piece of governance. You've already heard the story of a pig called Cedric and the British Gas AGM, and the concerns about directors' pay. The fact that executive directors seemed to get big pay rises even if companies were not doing very well. The fact that when executive directors lost office, when they were removed or left, they often walked away with very big payments, sometimes questions being asked about whether such payments were deserved. Some companies were paying their directors retention awards, basically paying them not to leave the board. And whilst a bit of board consistency makes a lot of sense, again, simply paying someone to stay when potentially they may have had no plans to leave in the first place is not necessarily something that we would agree with. So in 1995, we had the Greenbury Report, which looked at directors' remuneration. And we've already looked at remuneration and the key points that it included, including the importance of performance-related pay. So let's just make a note of where we've got to so far. In 1997-1998, we'd had the Cadbury Code for around 5 years, and it seemed like a good time for a bit of a review to see how well it was working. The Hampel Report looked into the effectiveness of the Cadbury Code over its first 5 years, and also looked at how well the Greenbury recommendations on directors' remuneration were working. And in 1998, we had the Hampel Report. To a great extent, not a huge amount changed. One thing that Hampel did suggest is that the Cadbury Code and the Greenbury Report and also Hampel's own recommendations were all put together into a single document, and so the combined code was born. One major point that Hampel did make is that there was a concern that companies were simply saying, yes, we've complied, and that as a result the Cadbury Code had become a bit of a box-ticking exercise. Yes, we've complied, or no, we haven't. The concern was that companies were not really thinking about how to comply. They were simply doing what they were told without a huge amount of thought behind it. So Hampel tried to change things to make it a more principles-based code, so that instead of doing X, you had to try to achieve X. And if you have something like, you must have an effective board of directors, well, how do you know if you have an effective board of directors? That is the sort of point that requires thought and requires companies to actually describe how they're going to achieve it. One of the other points that came out of Hampel's review of corporate governance was that boards of directors wanted a bit more help and guidance with their internal control systems. This was taken on as a separate project by Nigel Turnbull, and in 1999 he brought out a report giving guidance on what a sound internal control system might look like. And in a later part of this course we'll take a look at internal control systems and what Turnbull advised. So as we headed to the millennium, that's what we had. A combined code with the original Cadbury recommendations, Greenbury's thoughts on directors' pay, Hampel's revisions, especially moving it to a more principles-based approach, and Turnbull's thoughts on internal controls. And then everything went relatively quiet. In fact, there was a feeling that corporate governance was pretty much there, and that the major problems had been dealt with. And then Enron happened. In December 2001, Enron filed for bankruptcy in the United States of America. It wasn't the only big corporate collapse around that time, but it's probably the one that's most famous. As a result of Enron and also WorldCom, another major corporate disaster, the American government decided they needed to act. The result of this was that within 8 months of Enron filing for bankruptcy, the Sarbanes-Oxley laws were brought out. Now we'll look at Sarbanes-Oxley in a little while and compare it with UK corporate governance. But before we do that, let's just carry on the story in the UK. Now, the story of Enron is a complicated one and involves accounting standards in America which are different to what we use in Europe and in Britain especially. And there was a general feeling that what Enron had managed to do would have been impossible in Britain. Having said that, it's always a good idea to learn from mistakes, even if those mistakes seem to be happening somewhere else. So in Britain, we looked at our corporate governance, looked at what had happened with Enron especially, and asked, could we learn anything? Two of the major concerns with Enron were the performance of the non-executive directors and also the role of the auditors. So as a result of this, in the UK, 2 separate committees were set up after Enron in 2002 to look at the role of non-executive directors and the role of audit and the audit committee. In 2003, the reports of these 2 committees came out and alterations were made to non-executives and to the role of auditing. In particular, the independence of non-executives was strengthened as a result of this, and the role of non-executives more clearly defined. We've already looked at the roles of non-executive directors. You may remember there are 4 of them, and that was put together in the Higgs Report of 2003. Now, it's important to appreciate that the combined code is a document that is always being questioned and potentially updated. Since 2003, we've had another update in 2006, and also some minor changes being put through in 2007-2008. But for the time being, the combined code seems to be a fairly settled document. In general, there is support for the way it works. Most companies seem to be relatively happy and seem to have adopted it now as pretty much the standard by which they should operate. Some other countries have changed their corporate governance provisions in line with UK's combined code. Now, the UK's combined code is described as a comply or explain system. What this means is this: it is not law. It is not a set of rules that you absolutely must follow with punishment if you don't. And we'll look at how that differs from the American system, which is a set of laws, shortly. Under the UK system, the combined code is described as a code of best practice. In essence, it is a voluntary code, but the expectation is that most companies will follow it because, as a code of best practice, you'd need a pretty strong argument as to why you wouldn't follow it. But if you're a listed company in the UK, it is not really voluntary at all, because for listed companies, you are required to comply with it or explain those bits that you haven't complied with and why. Now, it is very difficult, if most companies are doing something and it's described as best practice, for you to justify why it's not so important for your company. And in fact, many companies who've tried not to comply with it have found they get a lot of criticism, especially in the press and from their investors, that they're not complying. The result of this is the vast majority of companies attempt to comply with everything, although there are exceptions. So a comply or explain approach is not really voluntary at all, and the examiner has made a big point of this. Generally, companies will comply, and you'd need a pretty strong reason not to. Now, we've already seen one example of a company not complying. We mentioned ITV when looking at the chairman-chief executive debate. ITV have an executive chairman. Michael Grade is both chairman and chief executive. So in their annual report, they have to explain that that point of the combined code has not been followed, and then explain why they're breaching it. In a more recent example of the same issue, Marks & Spencer have recently elevated their chief executive, Sir Stuart Rose, to become executive chairman as well. So again, he is chairman and chief executive. The interesting thing about this example is that not only do Marks & Spencer have to put this in their annual report, but because it has received such bad reaction from some of their investors and from the press, Marks & Spencer not only justify this in their annual report, they individually wrote to all of their shareholders trying to explain why they felt it was necessary to do it. So justifying your non-compliance with corporate governance might go beyond using the annual report, as you may need to justify it over and over to your shareholders before they're willing to accept it. And with Marks & Spencer's, whilst the shareholders have accepted this at their AGM, there is still a danger that in the near future they decide that this was not the right solution and force Stuart Rose off the board. What are the benefits of a comply or explain approach as against a comply or else approach? In other words, law. Well, some of the good things about comply or explain is that it's flexible. It accepts the fact that in some situations there may not be one standard set of rules for everybody, and so to a certain extent it has become self-governing. Generally, companies will follow, and you really need a very good explanation as to why you should breach it. What's nice about that is that because it's self-governing, the burden of law is less. Potentially corporate governance can be changed more quickly because it doesn't have to go through a legal process, and it tends to get more support from the business world because it's not seen as additional red tape. It's hard to complain about rules if there is a condition that says you don't have to follow them if they really don't apply to you. So there seem to be some fairly clear advantages. The danger, of course, is that if you allow companies not to follow what looks like best practice, some of the justifications for not following might not be that good. At the moment, at least, investors seem quite keen on corporate governance, so any non-compliance is likely to be questioned. But there may come a time when some companies don't follow the code and use fairly weak explanations in order to get around it. So that is comply or explain. Now, there is another issue that we need to think about with regards to the UK's code. It is very much a principles-based code rather than rules. It's similar to the comply or explain versus law argument, but we'll wait until we've looked at the Sarbanes-Oxley rules in America, the Sarbanes-Oxley Act, or SOX as it's known for short, before we look at that comparison in any more detail. So now we've spent a bit of time looking at the UK's combined code, let's now take a look at Sarbanes-Oxley. In December 2001, as we know, Enron filed for bankruptcy. It was a major corporate collapse in America, and it had far-reaching effects. It probably increased its importance that Enron were based in Houston, Texas, which happens to be the same state where the President, George Bush, comes from. In fact, it probably increased its importance that the chairman of Enron, Ken Lay, was the biggest individual donor to George Bush's presidential campaign. So George Bush and the chairman of Enron were rather close. The collapse of Enron was not greeted very well in America. There were other corporate collapses at the same time, WorldCom being probably the second most famous next to Enron. And the result of these corporate collapses was that the American government needed to be seen to act quickly. Now, America tends to go for rules rather than principles. It's an American trait. But the fact that George Bush probably felt that he had to be seen to be harsh in this situation just increased the likelihood that rules were going to come out of it. So, in July 2002, the Sarbanes-Oxley Act was passed, named after the two politicians, Sarbanes and Oxley, who sponsored it through the American House of Representatives and the American Senate, in other words, American government. Now, apart from the fact that the Sarbanes-Oxley Act is law, how else does it differ from the UK's Combined Code? Bear in mind it came around 10 years later, and so maybe conditions were different, but despite that, most of what Sarbanes-Oxley covers is pretty much the same stuff as the Combined Code. So it looks at the nature of the board, non-executives, independence of non-executives, board committees, risk management, etc., etc. So most of its content will be familiar to you if you've looked at the Combined Code in the UK. But there are some notable differences, not just in content, but in the nature of that content. And let's just take a quick look at some examples of that. We'll start off with the importance of the accuracy of the financial statements. In the UK, of course, the Board of Directors signs off the financial statements. But under the Sarbanes-Oxley Act, to try to increase the personal responsibility of getting those accounts right, the Chief Executive and Chief Financial Officer must put a written declaration into each annual report, and also quarterly reports as well, stating that the financial statements are accurate. It's a personal, sworn testimony. This means, of course, that if it turns out that the financial statements are not accurate, far more personal responsibility can now be attached to the CEO and the CFO. In fact, if it then turns out that the accounts are not accurate and they have to be restated, any bonuses paid to those directors have to be repaid. Now, potentially, that could be very harsh indeed. One of the most well-known or even infamous areas of Sarbanes-Oxley is Section 404, which looks at internal controls. Now remember, the Combined Code in the UK says that companies need a sound system of internal controls, and to make sure that it's sound and effective, should check that system of internal controls at least once a year. But under Sarbanes-Oxley, it goes further. Not only must companies have a sound system of internal controls, they must also have suitable documentation in place to provide evidence that that system is working. And on an annual basis, the directors must do a full review of the internal control system against agreed criteria and report the results of that review in their annual report, thus providing assurance that the internal control system is working. On top of that, their auditors have got to also provide a report saying that they have checked the internal control systems over financial reporting themselves and give their opinion as to whether they're working. Under the American system, this is called an attestation report. Now, typically, an attestation is where somebody says something and someone else attests, in other words, bears witness to the fact that what they've said is true. But in Sarbanes-Oxley, it actually goes further than that. And to be realistic, what the auditors have got to do is a full audit of the internal controls over financial reporting at the company. Now, as part of a normal audit process of the financial statements, the auditors would, of course, look at the strength of internal controls. But this is far more detailed. Basically, if the directors say, we have checked the internal control systems against these criteria and we believe they work, the auditors have got to check that entire statement. It is a very detailed piece of work. It will take a lot of time and be very costly. The result of all of this is that the costs of control systems in American companies have gone through the roof. And when I say American companies, bear in mind that Sarbanes-Oxley applies to any company with an American listing. And in order to get access to American investment, a lot of foreign companies also have listings on American stock exchanges. In fact, some, when Sarbanes-Oxley came out, were so appalled by the extra costs of complying with it that they ditched their American listings in order to avoid it. Some American companies left American stock exchanges and relisted in Europe, where corporate governance tends to be a little less harsh. So the internal controls issue is a big one. Let's just note down exactly what Sarbanes-Oxley requires companies to do. So that's what the company has got to do, and to prove that it's actually done this, don't forget they also have to keep documentary evidence of the control system and of the assessment that they have done. What we now need to do is have a brief look at the American auditor's role in this internal controls assessment. Remember, Sarbanes-Oxley requires the auditors to issue what is called an attestation report, confirming that the board have done what they've said they've done. But the thing is that the internal control report that the board put in is so detailed, the only way to confirm that they have done what they've said they've done is basically to audit the internal controls yourself so that you can agree or disagree with the director's conclusions as to the effectiveness of that system. Of course, as a board of directors in America, knowing that the full force of the law will come down on you if you don't do this properly means that, if anything, they may have overdone their internal control systems and overdone the amount of documentation just to make absolutely sure they're complying. On top of that, if you know your auditors are going to be checking it in detail, that's even more pressure to maybe go a bit too far. Many feel that Sarbanes-Oxley is too harsh in this area, and there are concerns that American industry has seen its costs go up and its effectiveness go down as a result of having to spend so much time making sure they're complying with this. So how is this internal controls audit, for want of a better word, different to the United Kingdom? Well, under the combined code, of course, directors do need to make sure there is a sound system of internal controls, and they need to confirm that they have assessed the controls in their annual report. But the difference is there is no need to actually present the results of that assessment in any great detail. And equally, there is no need for the auditors to go beyond their normal audit process on the financial statements and suggest any sort of comment on how well the directors have done it. So the combined code has got something on controls, but it's a lot less harsh than Sarbanes-Oxley. Some other points in Sarbanes-Oxley which are different to the UK's combined code. In Britain, loans from companies to their directors are generally illegal, although there are some exceptions. Under Sarbanes-Oxley, any loan from a company to one of its directors is against the rules, unless that company is a bank and the loan is in the normal course of business. As well as bank loans, another example of difference is in auditors. In the United Kingdom, your external auditors are generally allowed to perform other services on top of the audit, as long as independence is not breached. So generally speaking, most other services are allowable if suitable safeguards are put in place. Under Sarbanes-Oxley, there is a relatively long list of services which are banned if you're doing the external audit. As a result, in America, many firms of external auditors do the external audit and nothing else. One other area where Sarbanes-Oxley is different to the combined code is probably a good thing. Under Sarbanes-Oxley, there is greater protection for whistleblowers. What or who is a whistleblower? Well, a whistleblower, strangely enough, is someone who blows the whistle. Not in a tangible sense, but blows the whistle in terms of spotting something in a company that they don't like the look of and reporting it, either inside the company or maybe outside, in the hope that this problem is dealt with. So, for example, with both Enron and WorldCom, someone inside those companies, realising that things were happening that didn't look right or didn't look legal, tried to report it to get it sorted. Now, of course, if you report a problem inside a company and the person who's causing this problem finds out it's you, your life could be made a misery. In WorldCom, for example, Cynthia Cooper discovered what she thought were some extremely questionable accounting practices. Basically, the main issue with WorldCom was the amount of expenses that was being capitalised and hidden on the balance sheet or statement of financial position, thus increasing that year's profits. When she complained about this, the person who was doing it ignored her concerns. Thankfully, she went further and told the audit committee, and the audit committee tried to sort it out. This resulted in WorldCom's accounts being restated by several $billion, and WorldCom ended up filing for bankruptcy. But it takes a lot of bravery for someone to report potentially their own boss for behaviour which might be questionable. So Sarbanes-Oxley tries to issue some protection to try to encourage people to be brave and make those reports. Other countries have similar things in their codes of corporate governance as well, whereas in Britain there is really not much in the combined code to help you. Having said that, reports recently suggest that the whistleblowing procedures in Sarbanes-Oxley have not actually helped at all, and if anything, whistleblowing is going down because more and more whistleblowers are not being protected. So clearly this is an area which needs a bit of a rethink. Now, apart from what we've looked at, Sarbanes-Oxley is relatively similar to the Combined Code, and most of the areas covered are therefore basically the same. So just be aware that the main differences are Sarbanes-Oxley is law, it is tougher on directors, especially the CEO and CFO, in terms of the accuracy of the accounts, and it is extremely tough on internal control systems, as we've seen. What we now need to do is compare the law-based Sarbanes-Oxley with the principles-based Combined Code of the UK, and look at the positives and negatives of each. So, Sarbanes-Oxley is a legal-based system. America has chosen law. In the United Kingdom, Combined Code is a principles-based system. What are the features of the two systems and which system might be best? Well, let's first take a look at a legal-based system. Of course, if you have a system based on law, then as long as the law is good enough, the quality of the law should provide assurance to shareholders and stakeholders in general that the system is working. And of course, being law, non-compliance can be punished by removing the company from the stock exchange, or maybe just fining them, or in extreme circumstances, potentially imprisoning directors. The problem, of course, with law is that it lacks flexibility, and also, as America seems to have experienced, in making it law and making it so high punishment if you don't comply, there is a danger that companies overdo their corporate governance and therefore potentially suffer in terms of business performance. What about a principles-based approach? Well, a principles-based approach is more flexible. It means that companies of different size, culture, or maybe companies at different stages of development, like newer companies, can comply with those things that are sensible and explain away those things that don't really apply to them. As I've said before, there is a danger that companies might use poor excuses not to comply, but at the moment, because you are judged by your investors, generally speaking, companies are complying, or they seem to have reasonable explanations as to why not. It is generally felt that a principles-based approach is stronger than a laws-based approach because we'd rather companies complied with the spirit of good governance rather than simply ticking boxes. And there have even been some comments from America that maybe their law-based system would be better if it was altered to a more principles-based system. Maybe now that the point has been made after Enron that corporate governance is very important, the fact that it's law in America may be less important. So there we go, laws versus principles. If you were a developing country and you had no corporate governance code at the moment, what might be better for you? Copy the UK's Combined Code or copy Sarbanes-Oxley? Well, if you're looking for a starting point, I suspect the Combined Code is an easier place to be because its principles-based nature means that you could use those bits that you want to use and explain away those that you don't. Sarbanes-Oxley is probably not that helpful for those countries which are in an early stage of economic development because it is so detailed and so harsh. Let's note down laws versus principles. So, laws-based versus principles-based. An opportunity to compare the American system and the British system, and likely to be a key exam topic on many sittings.